In the 2021 Berkshire Hathaway Annual Meeting, Warren Buffett and Charlie Munger answered a question directly about how to invest in the current market since it seems so overvalued.
He says, if you deem stock prices to be overvalued or in a bubble, do you think it's best to keep your money in cash while waiting for prices to come down to a fair price? Or would it be a better idea to invest this money in some way while waiting until stock prices are fair again and then sell the investment to buy the stocks?
And I haven't actually seen anybody cover this clip specifically, so if you haven't seen the entire meeting, then you definitely want to stick around for this one. Today's video is sponsored by Sharesight, which is the portfolio tracking software I use to accurately assess my portfolio's performance. Sign up for a free account or get 4 months off a yearly subscription by heading over to sharesight.com/Hamish Hodder or by using the link below. Oh, and I have my puppy in the room with me today, so if you hear some scratching or barking or some interrupting during today's video, this is the cause of it, so you can direct your anger towards her and not me. Her fault, not mine. Before we get into the clip from the meeting, I think it's important to understand at a foundational level what it means to have an overvalued market, because there's actually a lot of different ways that you can define an overvalued market, but there is one way that makes the most sense. And before we even talk about the stock market, something is overvalued if its price is higher than its true value. So paying a far higher price for something than what it's actually worth underlying. And in the stock market, what a business is worth is dependent on the satisfactory return that the individual wants to make. So in other words, something is overvalued if it cannot deliver you a return you're satisfied with. And in the inverse, something would be undervalued if it can deliver a higher return or a return greater than the return you are targeting. And of course, that satisfactory return, that desired return, will differ from person to person. So what you mean by overvalued will differ from person to person as well, depending on what return they're actually targeting. But if you are a Warren Buffett disciple like me, then you are looking for businesses, you're looking for stocks that can deliver 15% or more yearly returns. So businesses that are delivering far less returns than that in the future, or are expected to deliver far less returns than that in the future, are what you would consider overvalued. And those stocks that do deliver safely a 15% or more yearly return are few and far between in 2021 and in some of the years in the past as well. And that is why currently people are calling the market overvalued. In my view, there's actually no way to know if the entire market is overvalued, fairly valued, or undervalued, or even to what extent, because in my view, that would take you understanding and having an accurate projection of the future cash flows of every business in the market. And I don't think that's something you can do. However, from the handful of business that I have been analyzing personally, and from speaking with other people who are also analyzing businesses in other areas, the prices of businesses right now are not good. They're not offering returns that are satisfactory for us as value investors. Monster Beverage Corporation was a company I recently revisited in terms of my analysis, and using my spreadsheet, I'm actually able to calculate the expected return of the stock, which is currently around 6 to 8% per year based on my projections of profits for the business in the future. And my projections for Monster Beverage are in no way slow, really conservative growth numbers. I'm projecting that by the next 10 years, they'll be doing 1 to 2 billion cases per year of energy drink, that their margins will improve dramatically, and that they'll actually see an increase in the average price per case sold at wholesale. So these are by no means very, very conservative metrics, and even using those, I'm getting to a 6 to 8% per year return if you buy the stock today. And Monster Beverage is just one that I picked out. It's not an outlier. If you're a student in our investor community, then you would know that over the past 2 months where I've been analyzing businesses and sharing that with the group, almost all of the businesses that we've looked at have had expected returns of between 6 and 8%. So that is really where the market right now is satisfied with in terms of what returns they're willing to pay, returns they're willing to receive when they buy stocks today. So if you're a value investor and you're trying to make a 15+% return like I am, what should you do? How do you navigate this market where most businesses, at least from what I'm seeing, are likely to deliver high single-digit returns or mid-single-digit returns at best? So fortunately, Warren Buffett did answer this question in the latest annual meeting for Berkshire Hathaway, and here is his answer to that question.
Well, Charlie and I have had that discussion on a lot of things. We bought some stocks we really don't know that much about, but I'm not really comfortable doing that.
You're used to shooting fish in a barrel, but that's gotten harder.
We've got probably 10 to 15% of our total assets in cash beyond what I would like to have, just as a way of protecting the owners and the people that are our partners from ever having us ever get in a pickle. You know, we really run Berkshire to make sure that we don't want to lose other people's money who will stick with us for years. We can't help what somebody does that buys it today and sells it tomorrow. But we've got a real gene that pushes us in that direction. But we've got more than we've got probably 70 or 80 billion, something like that maybe, that we'd love to put to work. But that's 10% of our assets roughly, and we probably won't get a chance to do it under these conditions. But conditions change very, very, very rapidly sometimes in markets, and we do have people that would like to join us, but the market option they have is too great for them. And if they're publicly traded, I mean, they basically can't. They would have great difficulty, then making a deal with us, because somebody else would come along with using other people's money. It's, we may be unhappy about the 70 billion, but we're very happy about the other 700 billion. So it's not like we should complain.
Warren Buffett's advice here is relatively simple, as it kind of always is, but we should talk a little bit about what it actually means and how we can break it down. But at a top level, his advice is really that it's just really challenging to invest in these market conditions, and that it's not going to be easy. There's really no good way to navigate things as it is right now. And what you should be doing is being patient and recognizing that even though market conditions right now are not good, if you're trying to find 15+% return investments, market conditions can change very, very rapidly. So what you want to be is extremely patient, but also prepared to invest in businesses if conditions do change. And I think this kind of advice gets misinterpreted. I think a lot of people think that as a value investor, you should always be waiting for a broad market crash, and that even though we saw a crash last year that was significant, 30+% for the US market and the Australian market actually as well, that we should just sit on the sidelines 100% in cash and be waiting for another one of those to happen. But that's not at all what it means to be patient as a value investor. Because sure, every now and then we do get a unicorn black swan event that comes along like we saw last year, and everything gets sold down. And a lot of those businesses that were offering 6 to 8% returns drop 40 or 50% in price, and all of a sudden they're offering a 15% return. But those kind of events don't happen very often. And to be specific, they usually happen around every 5 to 8 years. So waiting 5 to 8 years every single time to invest is probably not going to be a good strategy for delivering consistent long-term returns. But what happens in between those big, broad market economic crashes is specific businesses or specific industries or sectors go through their own unique problems. So while the rest of the market may be doing very, very well, there could be pockets of the market that are offering 15+% return investments. So your job as an investor is simply to understand some industries. You're not going to be able to understand everything. So figure out what you're passionate about and areas you understand a little bit already, and learn a lot about those industries and what businesses dominate those industries. Pick out the few businesses that you can identify as strong companies with good management teams, with distinct competitive advantages, and estimate what they are worth. Project the future cash flows of the business, enter those projections into my spreadsheet, and come up with a range in which you would be happy to invest in that company based on our target return. And then you just need to be patient, and market conditions can change very, very quickly. In March of last year, we saw some of the fastest changing market conditions ever. I remember prior to 2020, a lot of people were arguing that we may never ever see a crash again. And I think people are still arguing that today, even though we just saw one. But there were people saying, well, because everyone is investing in ETFs, that the market can't even crash. And then we had March, which came along, and the market went from the hottest stock market maybe in history, the biggest run for sure in history of going up, a bull market, to the fastest drop in history over the course of a couple of weeks where the market went down 30%. So things can change extremely quickly, broadly, but also with specific businesses and specific industries. And you need to have a pool of businesses that you've already analyzed, that you deeply understand, so you're ready to invest in them when opportunities arise. In these types of videos, I can't really go in depth into all of the little details of how to analyze a company, or else this video will go on for a couple of hours. So I do have a playlist of videos where I have dived deep and explained each section of Warren Buffett's principles. I'll leave it linked down in the description below. It's called the 4-Step Stock Analysis Playlist. And there's about 15 videos in there that each go through in detail some of the major steps that you need to go through when analyzing a company. So if you've heard everything in this video and you're not really sure where to start, that is a really good starting point in order to broaden your understanding of how we should break down companies, find really good businesses, and then figure out what they are worth. And as I mentioned at the start, today's video is sponsored by Sharesight, which is the portfolio tracking software that I've been using for almost 4 years now. Or maybe it is over 4 years now, actually. And it is a really, really good service where you can actually have all of your trades automatically imported into Sharesight, or you can manually enter them, whichever one you want to do. And it will accurately track your capital gains, your dividends, your dividend reinvestment plans, currency gains, and it will do a bunch of tax reporting as well, which will save you a ton of time and even money when it comes to tax time. And that is super important right now if you are in Australia or New Zealand, because the end of the financial year is coming up very, very soon. And with Sharesight, you can try a free plan, which gives you access to some features, and you can actually set up a portfolio and start tracking it immediately for completely free, and you don't have to pay ever on that free plan. So you can try it for free for as long as you want, or you can sign up to some paid features and sign up to a paid subscription. And if you do that using my link down in the description below, you'll get 4 months of a yearly subscription, which is a huge saving. So go check it out if you're interested. The link is down in the description below, or you can head over to sharesight.com/Hamish Hodder. But that is all for today's video. I hope you guys got some value out of it. And as always, if you did, I would very much appreciate it if you take the 2 seconds to leave a like on the video and hit that subscribe button if you want to stay up to date with content that I post in the future. You can even press that notification bell next to the subscribe button, and that way you'll actually get a notification when I'm posting. So if that's something you're interested in, then feel free to go ahead and do that. And I'm looking forward to reading your comments down in the comment section after this video goes live. But with that said, hope you guys have a great week, and I'll see you in the next video.